All right, this is part two of financial planning with Rizek. So you remember we have the trout family, brown trout and rainbow trout. They have about $3 million of total net worth. That's a breakup between $80,000 cash and money markets, investments all across the board here. We have the big chunk of it in a 401k, half a million in a 403b for rainbow, an IRA of half a million, and a brokerage account of 200,000. You'll notice immediately here they don't have any tax-free assets like Roth accounts or health savings accounts yet, although we plan for them to save in an HSA for the next 3 years as long as they're on a qualifying high deductible health insurance plan. That makes sense for them. And then the value of their home. They're thinking about moving to Texas or Arizona to be closer to family, but they're not sure yet. And the plan for them right now at 60 years old is to continue to work for a few more years before they retire. You'll remember where we left off last time. We were taking a look at their retirement analysis. And based on their plan, they had a 69% probability of success, which means that of all the scenarios we ran based on the financial plan we built together, 69, let's just call it 70% of them were successful, 30% of them were not. That 30% represents them reducing their standard of living, no longer having assets for them to live on, of course, other than their home and Social Security, because they don't have a pension. And so in that situation, they kind of run out of money, if you want to call it that, from a retirement savings perspective. But there's a few things we can do to increase that. And as you'll recall, we like to see that percentage above 85% to be pretty confident that their financial plan will be successful and they won't have any excess anxiety or stress around the decision to retire or stay retired. For them, it was really just two changes that we made to get them to 85%. One was we reduced their monthly living expenses by $300. So instead of them living on $7,000 a month, it's now $6,700. The second change we made is instead of them retiring at 63, if they work 2 more years and retire at 65, that got their plan to the 85% mark. So I'm going to make a change here and we're going to reset that. We're going to go back to kind of the bare bones plan that we had before. So there's no changes. You'll see they're both 69% now. So we're just fine there. And I want to take you through some Roth conversion planning for this couple. So let's navigate to the tax section here. And I want you to notice something. Now, this is going to be based on their proposed plan, which right now is the same as the current plan. That's showing them retiring at the age of 63. So you can see here's their income at 62. In the year they turn 63, boy, their income tax rate drops enormously. Why would that be the case? Well, you'll recall they have $80,000 of assets in the bank, money markets, high yield savings accounts that they can live on in that first year of retirement. And then they also have some assets inside of a brokerage account as well. And if they sell investments that they've held onto for more than 1 year, inside the brokerage account, they can get that favorable tax treatment, what we call long-term capital gains tax treatment. Right now in the United States, it's taxed at either 0, 15, or 20%. That's capital gains. So just kind of keep that in the back of your mind. You'll notice that in the next year or two, right, it's showing the next full year. So when they're 61 and 62, you can see their federal tax rate, and this is the effective rate. So let me just spend a moment on this. I think it's a valuable piece of information for you to understand. The way that we talk about taxes depends on the situation that we're in. But for most people, the effective tax rate is the most important one to consider throughout your life, I think. In most situations, that's because it tells you an average tax rate across every dollar that you're earning. So here, when they're both 61, for every dollar they earn, 13.8 cents goes to federal income tax. The state of California gets almost 5%. And FICA taxes get 9.3% for them in this situation. Remember, that's a combination of Social Security tax and Medicare tax. You can see that orange one, FICA, goes away when they retire, and that makes sense. But if we look into the future, a big chunk of their tax liability is coming on the federal side of things with a little bit of state income tax as well. This presents us an opportunity because you can see their income is high here when they're both working. Then when they both retire, income's low and it stays low for a period of time. And then their income comes up right around the time they turn 66 and 67. And it pretty much stays there at that same rate for a while. And then we're showing one of them passing away, the other one living on for a year or two. And, of course, nobody knows what's going to happen there. That's way into the future. And, let's just pause and realize financial planning at the end of the day, there's a lot of assumptions we're making here. But what we should be interested in is what's coming down the road in the next 5-10 years, because we can have relative certainty around what makes the most sense for them from a tax planning perspective as we look at their retirement future. Another word of caution. It's very likely that at the end of 2025, the Tax Cuts and Jobs Act will end or sunset, meaning that we'll revert back to Obama era tax legislation pre 2017 when the Tax Cuts and Jobs Act was passed. With that said, it's also very likely that the Trump administration and Congress will pass a series of new tax legislation. And it remains to be seen exactly what that looks like. What will tax rates be? And are there going to be changes to the standard deduction? Is that going to come back down? Are there going to be changes to the child tax credit? So there's still a lot to kind of shake out there, let alone the QBI deduction, qualified business income deduction. That's been a huge tax benefit for small business owners. But for the Trout family, they don't own a small business. They're just regular W-2 employees. And so for them, we're going to assume that taxes go back to Obama era tax legislation like they were pre 2017 and stay there perpetually into the future. Now, of course, you and I know there's going to more than likely be some tax changes, but that's maybe in some regards a little bit more of a conservative approach from tax planning. And I don't know about you, but I like to be conservative on these things. So, with that disclaimer, you'll notice that in the years they're 63, 64, and 65, their income tax liability is so much lower than it is down the road when they're retired. This presents a phenomenal tax saving opportunity by shifting some of the income they recognize in these later years to these low income years. Now, you may say to yourself, how do we shift income? Boy, there's so many ways. But for them, the obvious one is doing a Roth conversion. That's where we move money from their pre-tax retirement accounts, 401k, 403b, and IRA, to a Roth IRA. They can do as much or as little as they want, whenever they want under the current law. So if they decide to convert 5,000 bucks or 50,000 bucks, that's up to them. When they convert, however, they're converting pre-tax dollars to Roth. And when they do that, that generates ordinary income. But that's the goal here. We want to recognize income, in fact, increase their tax liability higher than what it would have been in these 3 years in an effort to reduce the tax that they would be on the hook for down the road in retirement. And that's built on the idea of tax brackets. Here in the United States, the way that it works is as you earn income, you fill up certain brackets, or what I like to call buckets. And once you fill up one tax bucket, then every additional dollar is used to fill up the next bucket at a higher rate. And right now, the tax rates are at 10 and 12%, and then we get a big jump to 22 and 24%, and then another big jump to 32, 35, and 37%. So you can see there's kind of the small tax rates, medium, and large. Now, nobody thinks they're in a small tax rate. At least I've yet to meet anybody. But it gives you an idea for kind of the jump there. I mean, that's a 10% difference from the 12% bracket to the 22. So let's take a look, and maybe I'll show you just another way to see this. This shows you the actual brackets. And again, we're assuming pre-Tax Cuts and Jobs Act tax rates. So what's 25 in this scenario is actually 22% today, assuming Congress does nothing. And then they pop down here to the 10% bracket, and then boom, they're back up to 25%. Capital gains bracket, again, that's at the 15% rate. Then they come down here at 0%. So that's another strategy they may want to consider. In addition to Roth conversions, there's something called tax gain harvesting. You may have heard of tax loss harvesting before in the past. That's where you sell certain positions at a loss and you use that loss to offset other income. Tax loss harvesting for this family would make a ton of sense in the years that they're still working, that they have high income. But it would not make sense in these years down here where their income is low. In fact, we want to do the opposite. Because if they can sell a position and buy it right back, yeah, they're on the hook for that gain. But that gain, if it's been held on to for more than 1 year, can be used to fill up the 0% tax bracket for capital gains, which for a married couple filing jointly in the United States today, it's about the first $95,000. So we look at all their other sources of income and then we layer on capital gain income. And as long as we keep that underneath 95 grand roughly, then we can lock that in at the 0% tax rate. And how about you? But it's pretty rare that you get the opportunity to take advantage of a 0% tax rate in the United States. We don't have such a thing on the ordinary income level like we do for capital gain income. So let me pause and maybe just clarify that for a moment. Ordinary income is the income that most Americans pay or realize and they pay tax on. Ordinary income are the higher tax rates in the United States right now. This is income that you work for, so earned income. It's income that you collect from rental properties, income from a business, income from interest, whether it's in a high yield savings account, a certificate of deposit. Sometimes we call them certificates of depreciation. CDs, interest from bonds. That is the type of income that applies at the higher ordinary rates. Then we have long-term capital gains rates. That's primarily investment-related income and qualified dividends. Okay, so now that you understand tax gain harvesting, that's us strategically selling a position at a gain, buying it right back. There's no wash sell rule like there is with tax loss harvesting. We're able to be thoughtful and strategic. So more than likely for this family, at that point in time, we do a combination of tax gain harvesting, which, by the way, only occurs within brokerage accounts. So the money that they had, and let me actually just open up a separate tab here. The money that they had in the brokerage account, if I recall, it's $200,000. That's where we can do tax loss harvesting and tax gain harvesting. But we don't do those inside of retirement accounts. So money inside of the IRA, the 401k, that's not going to have tax gain harvesting or tax loss harvesting. It's just this brokerage account. This one right here, the 200 grand. Okay, so back to the picture here. We're going to go to their effective tax rate, and we're going to move to this section, the tax strategy tab. Doesn't that just sound so exciting? Tax strategy. I mean, listen, this is what you were expecting when you tuned into this video. You knew what you were getting yourself into. So let's go, and we're going to go to the calibration tab. And let me come back and refresh this tab so we start all on the same page here. If they, when they retire, just take income pro rata or as a percentage, a little bit from their brokerage, from the IRAs, from cash in the bank, then they're not as tax efficient over the course of their lifetime. In fact, even if they're just a little more thoughtful about where they take money from, if they take money in this situation from the cash first, and then from the brokerage account second, and then from the IRAs third, and if they have any money in a Roth or an HSA, if we take that last, they're able to generate almost $15,500 more in assets by being tax efficient over the course of their lifetime. That's pretty easy. It's pretty tough. And I'm a financial advisor about to say this. It's pretty tough being able to generate a higher return on your investments without also taking on additional risk. However, if we can be strategic from a tax perspective in terms of where we're saving, and then when we retire, where we're pulling money out from, boy, that's an easy way to generate a little extra return. And a real financial advisor It's going to do a number of things for you. One is going to make your overall investments more efficient and hopefully help generate good returns for you, but they'll also save you on taxes. And the tax saving return, boy, that's where I think that's where the sausage gets made, because you're able to do it without taking on additional risk, frustrations, or headache along the way. Now, let's layer on Roth conversions. There's a few assumptions here. I'll point you to a few. One is the estimated terminal tax rate. The way that we can think about this is kind of the tax rate that you'll have at the end of your life, or in other words, that your heirs would be subject to when they receive those assets, if the plan is for you to pass that on to them. That's a big one here. So if I were to reduce the estimated terminal tax rate, that would make Roth conversions less favorable. If I increase the future tax rate, that will make Roth conversions look better. And that makes sense. I mean, think about it for a minute. If you're doing a Roth conversion today, you're accelerating income for tax purposes. So you're paying taxes sooner rather than later in your life, with the hope that that money in the Roth account can grow and compound tax free into the future, whether it's for you to live on or whatever the case may be. The longer you have money in a Roth account, the better off you'll be because of compound interest and the time value of money. The tax-free treatment should not be underestimated. Now, I won't get political with you, but I will tell you this. As a nerdy financial planner and CPA, when I go and look at where tax rates have been over the last 5 or 6 decades in the United States, we today are in an exceptionally low, historically low tax rate environment. Will that always be the case? I'm not so sure. In fact, I think at some point in the future, and it may not be today, tomorrow, or in the next few years, but I think at some point in the future, there will come a time where tax rates will be higher. And I don't think it's that far off either. And so if you're along that same line of thinking, you think, you look at the federal deficit, the amount of debt that the US has relative to GDP, gross domestic product, or in other words, how much income the overall economy in the United States is producing, you may be shocked. Maybe you're not. Maybe you find that it's like the average US consumer where they're spending more than they have. And they're certainly not living beneath their means. And they're financing a lot of their day to day operations or living through credit cards or debt. And that's essentially what the US government has been doing for a number of years now. So just keep that in the back of your mind. We can play around with what that looks like. We'll use 20% just in this example, but just know that that can also alter the financial plan and how much we convert at any point in time. So let's say we're going to fill up the tax bracket that's 10%. What does that look like for them? So look at this number off here to the right. You can see that if in those years, remember when they're 63, 64, and 65, if in those years they fill up the 10% bracket by moving money from the pre-tax retirement accounts to the Roth, they're able to generate $90,000 more in assets by being tax efficient over the course of their lifetime. That's huge. Let's see if we should convert more during that period of time than just filling up the 10% tax bracket. What happens if they fill up the 12% bracket? Remember, that's 12% today. What will be 15% at the end of the year if Congress doesn't do anything. So we'll refresh that. Okay, you can see in this example, it actually reduces the amount that they should do. Well, they're still better off. They're not as tax efficient as if they had just converted 10%. So we'll go back to 10%. Notice it's going to bounce back up. Oops, let me refresh. It's going to bounce back up to 90,000. Let me take you to see what would happen if they converted and filled up the 22% bracket. What do you expect would happen? Well, in this case, boy, that's the wrong choice based on the assumptions we've put in, because now they're paying too much tax. They're filling up higher brackets than what they'll be over the course of their retirement. And certainly that would not be advisable in this situation. So we're going to take them back down to the 10% bracket there. And you can see that's where we're at 90,000. Now, let me just pause here. You may be saying to yourself, all right, this is great. Now I know how much I should be converting, but how much? What are the actual numbers looking like in those years? Well, I'm glad you asked. Let's take a look. In this financial software, it's pretty powerful stuff here. We can see that the converted amount that they would do when they're 63, 64, and 65 is roughly 40 grand, almost 35,000 and 18,000 in those years. And that would come from the pre-tax retirement accounts and go to the Roth. And it tells us exactly how much they would do in those years to save that 90 grand over the course of their lifetime. That's pretty awesome. That's the power of real financial planning when you look at everything in whole. And there's a lot that we can look at. Let's look at Medicare premiums. This is one that people often have questions about. As we discussed, I think in the first video, the more income you recognize for tax purposes, the more you're on the hook to pay when it comes to Medicare premiums. Remember, specifically Medicare Part B and Medicare Part D, which is for prescription drug coverage. And you may be wondering, hey, if I do this conversion, if I recognize this income, is that going to cause me to pay more in Medicare premiums to pay IRMA, which is the income related monthly adjustment amount? Whew, what a mouthful. Is it going to cause me to pay more? And in this situation, it's not for this individual. Now, they will have income uh, potentially at a higher rate if they take more out of an IRA or 401k and they need that money to move, and if they need to buy a bigger house somewhere else. But remember, they're moving from California. Most people who move from California to Arizona or Texas, uh, they buy an equivalent amount of home, at least dollar wise, or less sometimes. So that kind of gives you a sense for where their Medicare premiums are at when they turn 65. There's another view that maybe be a little bit helpful for you here. These show you the brackets for Medicare when they turn 65, and you can see the IRMA amount as long as we keep their modified adjusted gross income, and it shows with conversion and without conversion. So let's just take a look for a moment here. You can see that green, the first line there, Magi with conversion, 127. So that's their modified adjusted gross income, including the Roth conversion that we're doing. And you can see, in fact, that right now under current Medicare laws, they could convert if they wanted up to $238,000. So they could generate a bunch of income through Roth conversion and still not be subject to an additional amount of premium for Medicare. Now, let's pause for a moment here and come back to the ordinary income tax. If they do a Roth conversion, so in this year you can see the same thing, their adjusted income with a conversion and without a conversion from year to year. We want to be cognizant too of how they're going to cover healthcare costs. Now, right now, we have them planning to retire at 63. If they do retire at 63, how are they going to cover healthcare? And if they go onto a marketplace plan, Obamacare, and they shop for health insurance for those 2 years before Medicare, you and I know that the amount of income they recognize, similarly to Medicare, the amount of income they recognize has a direct impact on the amount of premium they pay for Obamacare. Or, in other words, the more income they recognize, the smaller the subsidy they get through their state marketplace. So, something to be aware of. We want to navigate that. There's a little bit more complexity to trying to navigate subsidized health insurance pre Medicare, depending on where you live, your zip code, how many people are in your family, a number of other things. But just something to be aware of. I will say this when it comes to Medicare and healthcare planning before Medicare, we want to weigh the pros and the cons. In a number of scenarios, outside of this example with the Trout family, in a number of scenarios I've run with families and clients all over the country, it can, in fact, make sense to pay a few $100s extra per month for health insurance. Yeah, it stinks. Trust me, nobody likes to pay more for health insurance than they have to. But it can make sense to pay more for health insurance or more for Medicare in those years when you're doing a Roth conversion if the income tax savings combined with the new tax-free dollars in the Roth account outweigh the additional cost. So what I'm suggesting to you is in some cases it can make sense to pony up, pay a little bit more for health insurance if in your overall financial plan it makes sense. because of the tax savings and the assets now growing in a Roth account. So something to be aware of there when it comes to Roth conversions. There's a lot more we could dive into in terms of looking at the invested assets or the federal tax paid at different points in your life. But just realize that at the end of all this, once we calibrate it and model it out, this will improve the success of the financial plan for the Trout family over time.